Not because you broke the law, but because the rules changed and almost no one is talking about it. And this is where things get serious. If you're over 60, if you hold a green card, if you were born outside the United States but file taxes here, you may be stepping into a level of scrutiny that simply did not exist before. We're not just talking about paperwork. We're talking about automated IRS flags, increased audit exposure, unexpected delays in immigration processing, and in some cases, citizenship applications being pushed into limbo for months. Most people don't realize this until it's too late. I've seen it happen. One small overseas account, one missed reporting form, and suddenly 8 months of stress, thousands of dollars in legal fees, and constant uncertainty. All because someone didn't realize the system had already changed beneath their feet. And here's the part that shocks many immigrants. This change is already finalized. It's written into policy. It's built into the system. And when you sit down to file your 2026 taxes in early 2027, the system will not care whether anyone explained it to you or not. So today we're going to break this down clearly. What's actually changing, why seniors and immigrants are being affected the most, and most importantly, what you can start doing right now to protect yourself before this becomes your problem. Welcome to Policy and Pathways. I'm Sophia, and for years I've been tracking the intersection of tax policy and immigration law, especially the kinds of quiet regulatory changes that impact seniors, green card holders, naturalized citizens, and long-term visa holders. The hardest. I've watched too many hardworking families get blindsided, not because they were dishonest, but because they simply didn't know the rules applied to them. My goal here is not to scare you. It's to make sure you are never caught off guard. Think of this channel as your early warning system. When something changes that could affect your finances, your immigration status, or your long-term security in the United States, we break it down in plain, simple language so you can act before it turns into a crisis. And what's coming in 2026 is exactly the kind of change you need to understand early, because once the system is in motion, fixing mistakes becomes much harder. So, let's talk about what's actually changing. Here's what you must understand. The IRS has finalized a new reporting framework that takes effect starting with the 2026 tax year. That means when you file your taxes in early 2027, you'll be operating under a very different set of expectations. This isn't speculation. This isn't a rumor. It's already embedded into updated filing instructions and compliance procedures tied directly to Form 1040 and foreign asset reporting requirements. And here's the key shift. Questions that were once buried deep inside specialized international forms are now being brought directly onto the main tax return, the same form everyone files. In simple terms, what used to apply mostly to high net worth individuals or complex international cases is now becoming unavoidable for everyday taxpayers, especially seniors and immigrants, with even modest financial ties overseas. Under this new structure, foreign asset disclosure is no longer something you can easily overlook. The system is forcing clarity. If you have foreign bank accounts, overseas pensions, foreign social security type benefits, shared property abroad, or any financial connection outside the United States, you will be asked directly, and your answers will not exist in isolation anymore. They will be digitally compared with other records connected to your name. And this is where many people get confused. You might be thinking, I've always answered the foreign account question on my tax return. What's different now? The difference is scope and enforcement. Previously, deeper reporting requirements were only triggered after certain high thresholds were met. And in many cases, they required separate specialized forms that most average taxpayers never even encountered, unless an accountant specifically told them to file. Starting in 2026, that separation is shrinking dramatically. The system is becoming more unified and much harder to accidentally bypass. But here's where things get even more important. It's not just about visibility, it's about thresholds. Under the previous rules, if you were single and living in the United States, you typically only needed to file Form 8938, the statement of specified foreign financial assets, if your foreign holdings exceeded $50,000 at year-end, or $7,500 at any point during the year. For many seniors and immigrants, that felt comfortably out of reach. A small savings account overseas, probably below the limit. A co-owned property, often unclear. A pension abroad, frequently misunderstood, but under the 2026 framework for taxpayers considered higher risk reporting categories, including many seniors and immigrant filers, those thresholds are effectively tightening. In practice, we're now looking at trigger levels closer to $25,000 at year-end or $40,000 at any point during the year, in comparable situations. And this is critical. Any time during the year means peak value. Even if your account crossed that threshold for just one single day, it still counts. Think about how easily that can happen. Maybe you co-own property overseas with family and your share pushes you above the limit. Maybe you inherited a pension account you never touched. Maybe your parents temporarily transferred funds into a joint account in your home country. You weren't trying to hide anything, but your peak balance crossed the threshold and that's all it takes. And this is exactly where people get blindsided, because most taxpayers do not track peak balances throughout the year. They look at year-end statements and assume that's enough. But Form 8938 doesn't just care about December 31st. It cares about the highest value your account reached at any point during the entire year. Now, if this is already helping you understand what's changing, take a second to like this video, because early awareness can make the difference between a smooth process and a very stressful situation. And here's what becomes critical moving forward. Once these lower thresholds combined with increased visibility on your main tax return, the margin for accidental mistakes becomes much smaller. You don't need to be wealthy to cross these limits. You just need ordinary financial ties abroad, something millions of immigrants and retirees have. And this is only half of the story, because the other half is how your information is being checked. And this is where things become much more serious than just paperwork. It's not only about what you report, it's about how your answers are verified. There's another reporting requirement called the FBAR, the Foreign Bank Account Report. And most people don't realize how powerful this requirement actually is. Unlike Form 8938, the FBAR is not filed with your tax return. It's submitted separately through the U.S. Treasury Department's Financial Crimes Enforcement Network. And importantly, the threshold for FBAR has not changed. If the total combined value of all your foreign financial accounts exceeds $10,000 at any point during the year, even for a single day, you are required to file it. And here's where many people make a mistake. It's not per account, it's combined. If you have $4,000 in one account, $3,000 in another, and $3,500 in a third, you've already crossed the $10,000 threshold, even though none of those accounts individually reached $10,000. And this is the part that shocks many immigrants. For years, the biggest issue wasn't people trying to hide money. It was confusion. Some people checked yes on their tax return for foreign accounts, but didn't realize they also needed to file an FBAR. Others filed an FBAR but didn't properly report those same accounts on Form 8938. The systems were not always fully connected and many inconsistencies went unnoticed, but that is changing. Under the newer enforcement framework, cross-checking is becoming faster, more automated, and much more accurate. Your Form 1040 responses, your Form 8938 disclosures, and your FBAR filings are now being compared against each other almost immediately. If you say yes to foreign accounts but no FBAR is found, that mismatch gets flagged. If you file an FBAR but don't properly disclose those assets on your tax return, that inconsistency is also visible. And this is where things get serious because these systems are now communicating in ways they didn't before. And that dramatically reduces the chances that errors go unnoticed. Imagine this situation. You've had a $12,000 savings account in your home country for years. You use it occasionally when visiting family. It earns very little interest. You never thought it was important. Under older systems, you might never have been questioned unless you were audited. But now you will be directly asked about foreign accounts on your main tax return. If you answer no, but reporting systems show otherwise, that contradiction becomes visible almost immediately. And here's where this goes beyond taxes. If you are a green card holder, your tax compliance is not just a financial issue. It becomes part of your immigration record. When you apply for citizenship, immigration authorities have the right to review your tax history, and increasingly data sharing makes that process faster and more detailed. This does not mean every mistake leads to denial, but it does mean more scrutiny, missing FB filings, incomplete disclosures, contradictory answers. If you do nothing else after watching this, do these 5 things. First, create a complete inventory of every financial connection you have outside the United States. And I mean everything, not just what feels important. Bank accounts, even small ones, joint accounts with parents or siblings, retirement or pension accounts in your country of origin, foreign life insurance policies that build cash value, investment or brokerage accounts, real estate you co-own, business interests, anything connected to your name or anything you have signature authority over, anything connected to your name or anything you have signature authority over. Most people don't realize how much they actually have once they start listing it all. For each account or asset, document the institution name, the country, the account number if applicable, and most importantly, the highest value it reached at any point during the year, not just December 31st, the peak balance, because that number determines your reporting obligations. Second, determine whether you are required to file an FBAR, not only going forward, but for past years as well. Remember this clearly. If the combined value of all your foreign financial accounts exceeded $10,000 at any point during the year, even for one day, you had a filing requirement. And this is where things get serious. If you're realizing right now that you may have missed FBAR filings in previous years, don't panic, but don't ignore it either. The IRS has streamlined compliance procedures specifically for taxpayers whose non-compliance was non-willful, meaning you genuinely did not know. These programs can significantly reduce or even eliminate penalties if handled correctly, but timing matters. Coming forward voluntarily is always viewed more favorably than waiting until you are contacted. Third, evaluate whether you will cross the Form 8138 thresholds under the Titan framework. If your foreign assets are approaching $25,000 at year-end or $40,000 at any point during the year, you need to start preparing now. Gather your documentation early, statements, valuation records, ownership percentages, because waiting until tax season increases stress and increases the risk of mistakes. Fourth, review any foreign pension or government benefit you receive. This is where many seniors get caught off guard. Some assume that because a pension is paid from another country, it is only taxed there. But the United States taxes worldwide income for citizens and tax residents. And this is the part that shocks many immigrants. Even if the income comes from abroad, it may still need to be reported. In some cases, tax treaties can help prevent double taxation through credits or exclusions. But those benefits must be claimed correctly. This is not something you want to guess. If you receive foreign retirement income, social insurance payments, or distributions from overseas accounts, speak with a professional who understands international tax rules. And fifth, especially if you are going through the citizenship process, keep everything organized. Your tax returns, your FBAR confirmations, your Form 8938 filings, any correspondence, keep digital copies and physical backups, because if immigration authorities request documentation, being able to provide it immediately shows compliance and seriousness, and it can significantly reduce stress during interviews. Now, let me bring this into a real-life situation. Last year, I spoke with a woman. We'll call her Maria. She was 68 years old, originally from India, and had lived in the United States for over 2 decades. She raised her family here. She worked here. She paid her taxes every single year. She believed she had done everything right. When she applied for citizenship, she expected a smooth process. During her naturalization interview, the officer asked a simple question. "Do you have any financial accounts in foreign countries?" Maria paused. She did. A savings account in India with about $15,000. It wasn't hidden. It wasn't secret. It was simply part of her life before immigrating, something she used occasionally when visiting family. But she had never filed an FBAR. She didn't know she needed to. Under older systems, this might have gone unnoticed, but not anymore. This is where things get serious. Integrated reporting systems detected the inconsistency. Her case was flagged for further review. What should have been a joyful milestone turned into 8 months of uncertainty. She had to hire a tax professional, file FBARs for prior years, prepare written explanations showing her non-compliance was not intentional, submit years of financial records. The financial cost was nearly $3,000, but the emotional cost was far greater. For months, she lived with fear that a mistake she never intended could jeopardize her citizenship. Eventually, her case was resolved. Authorities accepted that her error was non-willful. She was approved, but she said something that stayed with me. If someone had explained this earlier, I would have fixed it immediately. And that is exactly why we are having this conversation now, before 2026, before filing season 2027, before enforcement becomes even tighter, because the difference between a smooth process and a stressful one is often just early awareness. Now let's talk about the part most people avoid: penalties. Not to scare you, but to give you clarity. Because once you understand the consequences, you are far more likely to take action. If you are required to file an FBAR and you don't, the penalties can be severe. For non-willful violations, meaning you didn't intend to hide anything, the penalty can be up to $10,000 per account per year. Read that carefully. Per account. Per year. If someone had 2 accounts and missed 3 years, the penalties add up quickly. If the violation is considered willful, meaning you knew and chose not to comply, the penalty becomes much more serious. It can reach the greater of $100,000 or 50% of the account balance. Imagine having $60,000 in an overseas account and facing a $30,000 penalty, and that's separate from any taxes owed on income. Form 8938 has its own penalties. Failing to file when required starts at $10,000. If the issue continues after notification, additional penalties can apply, potentially up to $50,000. And it doesn't stop there. If income from foreign assets is under-reported, accuracy-related penalties and interest can also apply. And here's something most people don't realize. The statute of limitations can extend. Normally, the IRS has 3 years to audit a tax return. But if foreign income is omitted or required disclosures are missing, that window can extend to 6 years. And in cases involving fraud, there may be no limit at all. That means issues don't just disappear over time, they can follow you. And if you are in the immigration system, this becomes even more important. Immigration authorities evaluate something called good moral character, repeated tax non-compliance. Unresolved issues or willful violations can raise serious concerns. This does not mean automatic denial, but it can lead to deeper scrutiny, more questions, and longer processing times. Now let's clarify something important for seniors. These 2026 changes do not affect how U.S. Social Security benefits are taxed. That remains the same. Depending on your income, up to 85% of your Social Security benefits may be taxable, just like before. But this is where you need to pay attention. Foreign pensions and overseas benefits are different. If you receive payments from another country's retirement system, Canada Pension Plan, UK State Pension, Germany's public pension system, or similar programs, these are generally part of your worldwide income. And this is where things get serious. As a U.S. tax resident or citizen, you may still need to report them. Tax treaties may help avoid double taxation, but only if applied correctly. Starting in 2026, questions about foreign pensions and benefits will be more visible in the reporting process, which means fewer chances to overlook them. And for retirees with ties to multiple countries, this is especially important to review now, not later. The goal here is not to overwhelm you. It's to give you clarity, because when you understand what's changing and what isn't, you can move forward with confidence. And now let's bring everything together. At the end of the day, this all comes down to 3 key principles. First, knowledge gives you control. Most people who run into trouble are not criminals. They are everyday people, retirees, families, immigrants who simply didn't realize the rules applied to them. The fact that you're learning this now before 2026 puts you ahead. You have time. Time to review, time to correct, time to prepare, and most importantly, time to avoid problems. Second, professional guidance is protection. International tax reporting is complex. It involves IRS rules, treasury reporting, and often immigration considerations. A standard tax preparer may not fully understand FB rules or international compliance. If you have foreign assets, it is worth speaking to someone who specializes in this area, because fixing mistakes later is almost always more expensive than doing it right the first time. And third, protect the life you've built. Whether you came to the United States years ago or recently, your stability matters. A simple reporting mistake should not create stress in your life. Compliance is not about fear. It's about control. When your records are clean, your filings are accurate, and your documents are organized, you remove uncertainty. And that peace of mind is powerful. If this video helped you understand what's coming, take a moment to like this video and share it with someone who needs to see it, especially seniors or immigrants who may not be aware of these changes. And if you haven't already, subscribe to Policy and Pathways and turn on notifications because these kinds of regulatory changes don't always come with warnings. Staying informed early is one of the best ways to stay protected. And before we wrap up, one important reminder. This video is for general formational purposes only and does not constitute legal, tax, or immigration advice. Every individual situation may vary based on visa status, residency, financial structure, and country-specific regulations including the USA, UK, and Canada. Always consult a qualified immigration attorney, tax professional, or licensed advisor before making any decisions regarding your visa, green card, foreign accounts, or tax filings.